Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy Wednesday and spending it with us. We have another fantastic show for you today. I had the pleasure of catching up with a couple of my favorite people. Actually, it's probably been about a year since I had these guests on. Yes, we actually have a couple of guests on today as part of a panel to discuss some of the questions I've been getting from investors regarding investing in general. Should I be, moving my money to cash, or, I don't have a lot of time to make up any losses in the market. What should I be doing? And we brought on a couple of individuals, fantastic people, Patricia Levitt-Reid, Patty Levitt-Reid, former commentator, chief financial commentator for CTV News. A lot of you probably know Patty. She's been on TV for quite a bit over the last decade, and she's also done a lot of radio. She used to also be over at TD Waterhouse, vice president over there, managing money there as well. And we also brought on Jonathan Chevreau, and some of you may recognize Jonathan. He wrote a column for, I believe it was 19 years, for the Financial Post. He's the editor, investing editor at large for Money Sense magazine. He is the founder and CFO of Financial Independence Hub, which is an online website which provides a lot of great information regarding investing. So we brought on the two of them, and they're going to be talking. Well, I'll be speaking with them on our first segment of our show. Got a chance to catch up with them this past late last week. I think it was Friday, and we'll bring you that interview just shortly. But let's put up all the rest of our topics for today's show as well. There you have it. Investor Psyche, managing portfolios in volatile times. A panel discussion with Patty Levitt-Reid and Jonathan Chevreau. We'll then get into, I guess, everyone's favorite topic, which are tariffs. Trump administration shifts tone on tariffs, and he's definitely shifted his tone many times in his first 100 days of office. I think the Trump administration just reached their 100th day in office, and we have a bunch of stats that I think you will find quite interesting. Top 3 things to consider over the next 5 to 10 business days. Again, this is the part of our show where I talk about 3 things that I think as investors we should focus on going forward for at least the next couple of weeks until our next show, and perhaps new ideas come about. Unique buying opportunities as tariff situation evolves. And bottom line for me is, I think you should always be an investor. And I've been getting a lot of investors saying, if I have some money put aside right now, not really doing anything with it, should I be trying to take advantage of the recent market sell-off? Well, my answer always is the same, in that I think you should always be an investor. If you have money to invest, I don't think you should try and time markets. I think you should just put the money into the market at whatever time you have the money available. And obviously, it's up to your investment advisor or yourself, if you invest for yourself, to find the best investment at that time. However, based on the recent decline in the markets, there are a lot of bargains to be had right now. So we'll get into that. American consumer confidence falls again for the month of April. We've seen a steady decline in American consumer confidence. We should see this start to play out in the economic data. Perhaps we're not going to see as much in the retail sales numbers. We might see inflation start to move higher. We're going to see, a lot of people are predicting we're going to see a definite slowdown in growth, GDP. We actually got some GDP numbers on both sides of the border this morning, and not that good, definitely below what was expected. So consumer confidence plays a big factor in that. Quick hits, 3 things, 3 ideas that you've probably seen in the news recently. I'm going to talk about those. And last but not least, try to get to as many of your questions as we can. I know the odd time we get questions throughout the week, but also we get questions as well during our show. So try and answer as many as we can, 1 or 2 at the very least. So without further ado, let's move on with the show and get on with our panel discussion with Patty Levitt-Reid and Jonathan Chevreau. Welcome back, personal finance expert and financial commentator Patty Levitt-Reid to our show. Patty is known for providing tips on how people can save money and stretch their incomes. Many of you will recognize Patty from her days as a former senior financial commentator for CTV News She also served as a senior vice president at TD Waterhouse, Canada. Welcome back to our show, Patty. Thanks for
Thank
being
you.
here.
Thanks for having me.
Excellent. I also like to welcome back Jonathan Chevreau to our show. John is an author, the CFO, and founder of the Financial Independence Hub, North America's gateway to financial independence, the investing editor at large with Money Sense magazine. And many of you may recognize John from the personal finance column that he wrote at the Financial Post newspaper for 19 years. Welcome back to our show, John. Thank you for being here as well.
Thanks for having me back here, Alan.
Hey, it's great to have the two of you back. As I said, the last time, I think it's been about a year that we had both of you on. Times have definitely changed
Mhm.
since then. A lot has happened, perhaps for the good and maybe not so good. Investors are definitely a little bit more, should I say, concerned about what they're seeing in the world today. And there's a lot going on. So, wanted to, as I always do, start off with more of a general question for the both of you to answer. And I thought about asking, with respect to the uncertainty in the world today, inflation fears, tariff worries, possible slowing of economy, possible job loss due to tariffs, et cetera, on both sides of the border, Canada and the US. What would your general comments be to investors right now? Would you be telling them, not to worry, that this is a buying opportunity? Would you be saying, no, you may want to think about selling, getting out of this market? Perhaps you would say nothing at all, just hold tight. What advice would you give investors and why? And I guess we'll always start ladies first. So, Patty, what would you be saying to investors today?
Well, here's the thing, Alan. I fortunately or unfortunately have been around in this business for a long, long time. I could go back to 1995 when we had the Chinese financial crisis back then. I could then say, all right, then move forward. We had dot-com bubble, we had 9/11, we had 2008, the global financial crisis. I think there was the China's currency crisis that was in 2015. Then we had COVID. And now we have what I call the triple T, and that would be Trump trade and basically, well, call it whatever you want to call it, but it's all tension. So, every single time we go through this market turmoil, I have the same feeling, ooh, it's different this time. And it is different this time in that we have an individual sort of wreaking havoc on a global platform. But I've said that every time. And so I always believe in long-term quality investments, stay the course. You may get a little more defensive in your portfolio with utilities and telecoms, financials. Gold has definitely been a benefactor, and you stay the course. But if you're not sleeping at night, then talk to your advisor. There may be some tweaking required. I can tell you in the interest of disclosure, we've done nothing. We're staying the course with our portfolio.
So I guess you would be saying stay the course. So you're on the do nothing, just wait it out and see how it goes. John, what about yourself? What would you be saying to investors today? What are individuals that you come across every day and at your job and what you're doing? What are they telling their investors right now? Are they saying to just do nothing and stay the course, or are they perhaps using this as a buying opportunity?
Hmm. Well, going back to Patty's three T's, I thought she was going to say terrified. That's
Terrified.
terrified.
Trump trade tension, but
Yes.
whatever.
On my Financial
Tariffs.
Independence Hub a couple of weeks back, another advisor, John DeGoey, I'm sure you guys know him,
Mhm.
uh, had a blog which was titled "The Gangster in the White House," and he was a little bit less politically correct than a lot of people in his position
Ooh,
are
yeah.
about that, and he was sort of like departing from the usual. That I mean, I would agree with Patty normally. It's like stay the course. It always makes sense. It never makes sense to panic. Nobody ever made money panicking. But to go is arguing like with this madman in the White House. I saw the National Post had an article today on this really gloomy um, study about Canada being in dire straits, and there was a reference that they flagged right on the front page about madman in the White House. So De Goey's argument is sort of that all bets are off. Like this time is different. Maybe this time it is different. So he was just certainly advocating for retirees at least, dialing down risk, as he put it. Now, I mean, Patty mentioned there are many things you can do. There are consumer staples and defensive stocks and
Mhm.
utilities and healthcare stocks. Those are still stocks, though. From an asset allocation. I mean, I just turned 72 and now I have a riff. So I've all these years of talking about RSPs, and all of a sudden I gotta like sell stuff every year, every month. And luckily, again, going back to Patty, I had some gold I could sell because I bought it way a long time ago. And it's tough to sell losing positions. So my own personal financial advisor, he's more or less again for riff ages, rather than the classic balanced fund allocation of 60/40 stocks bonds. He's flipped it to 60% fixed income. If you're a cautious conservative investor and you don't have a traditional employer pension plan, even 80% fixed income. Young people, yeah, of course it's a buying opportunity. If you're under 30, and you should be thanking your stars that King Trump has given you this buying opportunity.
King Trump, I like that. I like that. So
Mhm.
I guess that you're saying depending on age and depending where you are, investment objectives, then you could be a person holding or perhaps using this as a buying opportunity. I like that. And I guess your comments about riffs and yourself leads me actually to my first or my next question, I should say. And we'll ask you, John, since you brought it up. I wanted to really focus on investor psyche at this point in time, investor emotions, because I talk a lot, as you both know, to investors everywhere, business owners, to sole proprietors, to just the average investor with their RSPs or RIFs. And people are nervous out there and they have a lot of questions. But a couple of questions that have come up quite often, I thought I would throw to my panel today, to the two of you. And the first one is stemming from your comments, John, about RIFs, is that I get the question most often, I am approaching retirement or I just entered into retirement. I don't have a lot of time to make up for any big losses that are happening now or that may happen down the road. And so people are asking me, what should I do? They have those comments. So what would you say to someone who says, I don't have a lot of time to make up any potential for big losses. Now how should I structure my portfolio?
Well, I mean, just to flog my blog again, today, actually, BMO's a sponsor and they get a monthly blog. And today is actually on asset allocation ETFs. And of course, iShares has them and Vanguard. Everybody has these things. It can be very simple. I mean, it just like it makes sense to use a professional advisor like yourself, Alan, or to Goey or anybody else, or Patricia when she was in that end of the thing. It also makes sense when you have ETFs certainly seem to be the accepted investment vehicle these days. An asset allocation ETF, basically you're punting it over to the professionals. Let Vanguard or let iShares decide what your asset allocation should be, having done your investment questionnaire and decided your risk tolerance and your stage of life, whether it's 60/40, 80/20, whatever it is. Once you've decided and it's considered how you're freaking out about the madman in the White House, tariffs is going to wreck everything, the prices of everything, inflation's taken off, gold's taken off. Let them decide. Yes, stay the course, but stay the course with the professional vehicles that have already taken into consideration where you are in your personal journey,
Mhm.
your age, and what other sources of income you may have.
Yeah, and great points for sure. Patty, what would you say? I'm sure you've had this come up in your
Yeah,
career when you
yeah.
were managing money at TD perhaps, and someone says, you know what, I'm turning 70 next year. I don't have a lot of time before I have to change my account over to a RIF. I'm nervous, if I have these big losses, I won't have enough time to make back some of these losses before I actually start pulling money out. How would you advise them at that point?
Well, I just want to go back to, and I have been talking to retirees, near retirees. We could spend a third of our life in retirement. That's a long time. We've been talking about being terrified with the tariffs, the trade tension, and, everyone's talking about inflation. And so I think it's about maintaining your purchasing power with a balance. And I do think stocks for the long run. Now, that doesn't mean you become overexposed. There is a big difference, and I understand what Jonathan's saying, because, my whole life and our whole life here is, been asset accumulation. To some extent, it's asset preservation now. And so we have taken some risk off the table, but we didn't do it in the midst of a crisis. We've done it through lifestyle, life stage. And I think for people who are in retirement, you need to be razor sharp on where is your money coming from in retirement. To Jonathan's point again, do you have a pension plan? Do you have a RIF? Do you have government benefits? What makes sense and in what order? And depending on when you retire, if you have a 5-year time horizon, and, many do, Jonathan, you do, I do, I'm just going to throw it out there. We have time to allow the markets to come back. And so the last thing I want is for someone to have this feeling of capitulation, throw in the towel, move to the sideline, panic. And then you're absolutely right. You are locking in potentially a loss that you may not have time to get back. So I still maintain in the midst of a crisis, it's not always the best time to rebalance, but it's always a good time to look at that asset allocation and making sure that if you don't have the strength and the fortitude to allow to sort of check some of the emotions at the side, work with an advisor, work with a planner. We have a planner. I have the credentials. I could manage money again, but we have someone managing our portfolio. We're checking in regularly. And we're looking, where's the strength? Where do we come back?
Yeah, no, all great, great advice for sure. My next question, I'll ask Patty first because I'm sure you've heard this one many times, and I've been getting it a lot lately. And it's the question of, Alan, why can't we just exit the market and go back in when the coast is clear?
Yeah,
I get that a lot.
me
And
too.
people, when they ask me this question, I think they know what I'm going to say, and they don't even realize, I say, well, you can't really time markets, but am I timing markets, Alan? I just want to get out. And then, when things look better, maybe when some deals are made down the road, maybe the market will look better and I can get back in. What would you say to an investor that asks you that question? Should I get out, exit,
Yeah.
and get back in later when everything looks better?
Here's what I know for sure. No one in the market or the markets themselves are going to wave a white flag and say, hey, by the way, the market has bottomed. It's now time to get back in. And statistically, I don't have the numbers at my fingertips, but statistically, we know rallies happen very hard, very quickly when you least expect it. If you exit the market, you lock in that loss. And then when things turn very quickly, some of the biggest gains happen immediately after we presumably hit near or at that bottom. And so therefore you have locked it in. But I still go back. I mean, if you're that nervous, you're not sleeping, maybe your exposure into the stock market was never right to begin with. And so that's a different conversation rather than trying to time the market, because you got to get it right twice, going out and more importantly, getting back in. And I would argue there are a lot of experts out there that don't necessarily get it right 2 times.
Yeah, no, absolutely. And I would argue even that getting out is easy, getting back in is the
Mhm.
hard part of
Yeah, it
that.
is.
Second part is obviously much more difficult. Along the same lines, John, I also get this comment made, and I laugh sometimes when I hear it because it's kind of funny. And investors call me up and they say, you know what, Alan, I'm not blaming you, but I knew that this was going to happen. I should have exited the market at
Yeah.
the end of January. I knew this was going to happen when I saw the new president in the White House and et cetera, et cetera, and they're beating themselves up because they knew that they should have exited the market. What would your response to that be?
Well, how good is your crystal ball? Hindsight is 2020. That's, I can give you many cliches. Um, again, we have this madman in the White House who can move the markets. We've already seen it, like 2,000 points in a single day, just on a whim.
Mhm.
And so you could have said this person who saw what was going on and they had a crystal ball that was better than yours or Patty's or all of ours together. Yes, it's definitely going down, and there are ways to play the short side and put options, etc., hedging, etc. And then, had you done that, we were joking about it in our family, the day just about 2 weeks ago, that day when Trump paused the tariffs for 90 days, what did this Dow go up? Almost 2,000 points. That day, if you'd been short the day before, you'd have been killed.
Yeah.
So it would have been, I mean, look, nobody has a crystal ball. I mean, yes, you should be cautious right now. Even if Kamala Harris was in power, I wish she was, I would still be cautious. I mean, right now, Warren Buffett's work Berkshire Hathaway has, I believe, US $325 billion in cash. I don't think there's been an investment vehicle in the world that has had that much cash. Yeah, he's, what's he, 95 years old or something like that. He clearly thinks things are a little overvalued, at least in the US. But even then, even though he's famously sold a lot of Apple, he also has a lot left. So again, it goes back to asset allocation. We could get into what it should be, but one of the newsletters I do follow, Gracewell, they're right now 15% in gold and precious metals, and I think they're 40% in stocks, conservative dividend-paying stocks, 15% in what they call more aggressive speculative plays. Just to give you a rough idea of what their asset allocation is, they're certainly not. I mean, it's crazy to do 100% in any one asset class for any reason. That those kind of extreme moves. I mean, I was just the other day, a friend was asking this exact thing. This is what I said: like, don't make extreme asset allocation moves over transient things like who's the president.
Yeah, no, and you can tell Jonathan does these interviews all the time because he always leads me into my next question. You mentioned the crystal ball. So now we're going to ask both of you for what your crystal ball looks like. I think I did this last time you guys were on, and so I want you to dust off that crystal ball, and I want you to make predictions for the end of the year. Do you think we're lower or higher? And I guess taking it one step further, do you think everything on the tariff side works out favorably? What would you say to investors today based on your outlook of would we end up the year higher or lower from where we are today? So let's start off, Patty. What do you think? Are we
Oh,
higher today? Are we higher, sorry, at the end of the year, or are we lower at the end of the year?
oh boy. The wild cards are very serious, and it's one of those things that, the outcome of the election here in Canada, by the time this is aired, we will all know in all likelihood, or be very close to knowing. I think the relationship with the US administration's getting a lot of pressure. I think, can I say it this way? I think the S&P TSX will outperform just based on our composition. We're very attractive. It hasn't always been our time. I think it's our time to shine. We're not down all that much. Gold, metals, yeah, doing a lot of the heavy lifting. All right, so I'll go out on a limb. That's a long way to hedge my bet. Um, I'm going to say we're going to be higher than where we are today.
Excellent, excellent. I would agree with you, and you're right.
Oh.
The TSX, the gold component obviously is outshining everything, and TSX is actually flat right now for the
Mhm.
year. For this year, this calendar year. Obviously, if you go 1 year returns, it is negative, but if you go this calendar year, Jonathan, what would you say? Are we higher? Are you in the higher camp with us, or do you think we'll be lower, or do you think things will just be about the same? And what do you think about the tariffs? Are we going to get through this tariff time, or will we be talking about tariffs come October, November?
Well, I mean, this 90-day tariff pause is the $64 billion question, isn't it? I mean, I think Trump will water it down, but want to save face. So there's still going to be tariffs, but they're not going to be as extreme. We saw him basically capitulate to China in the last couple of days, and so I wouldn't want to be inside his mind and his brain, but if I did, I would say he'll probably water things down sufficiently. He says he doesn't care about the stock market and Jerome Powell and blah 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 blah, but he does, and he figures that's how he's measured. He doesn't want to be this president who's going to be responsible for the Great Depression and the biggest stock market crash of all time. Yes, he could crash it tomorrow if he wished so, and I'm sure he'd have insider trading, and all his little buddies in Congress people would get the alert as they did last time and go short and make a killing. But I think he'll water it down. So long story short, I think probably the markets will be slightly higher. I agree with you both by the end of this year because he's going to capitulate. But if he doesn't, look out below.
Wow. All three of us in the positive camp. This is fantastic. I love to hear that. And I would just add to that that I think, President talks about having the cards. You've heard him reference that with President Zelensky and in Ukraine and others. You don't have the cards and the US has the cards. Well, I think ultimately the market has the cards. And I think the market will dictate whether it's the bond market, the stock market. I think the bond market even more so than the stock market. And I think that's what got the president to have that or mention that 90-day pause when he did. So yeah, I think I think the president, no different than all of us, we're at the mercy of the markets, the bond market in particular, and I think he will take his cues from there. So Patty Levitt-Reid, Jonathan Chevreau, I want to thank you both for coming back on our show and being part of our panel today, talking about investor questions and all the different issues or ideas that investors have right now. And unfortunately, there's a lot of panic out there, as I said off the top. And hopefully today we've helped someone that's watching and listening, make sense a little bit better out of what's happening in the world today. So I want to thank you both. And I look forward to having you both on again. Hopefully we don't have to wait another year to have you both on. We can have you both on sooner. So thank you so much. And we'll talk to you soon.
Thanks a lot, Allan.
Thank you, Allan and Patty.
What a great interview. That was fantastic. I had the opportunity of talking to both of those individuals late last week. And I guess a great takeaway, right, from the last segment there. Everyone's positive. I guess we all think that the markets will be higher come end of the year, higher than where they are today. So that is a positive. I know for different reasons perhaps, but it's good to hear that we're all thinking positively. So wanted to get to our next topic for the show, which is the Trump administration shifting tones. And yeah, obviously we all know what's happened the last couple of months. The idea when the Trump administration came on the scene, when President Trump was inaugurated in January, talked about tariffs. And we all knew what that meant, but I don't think anybody really realized how high these tariffs were going to be. And in fact, President himself said he's going to be a little bit lenient when he put these tariffs on. And in the end, he wasn't lenient at all. The numbers were a lot higher than what we thought. On April 2nd, he announced reciprocal tariffs on something like 185 countries. And I guess the game plan from President was that he was going to issue these tariffs and basically kind of have a bit of a blackout period where he really wouldn't talk to anybody about them. He would let things stew a little bit. And he had a lot of the people that are part of his administration go out and say, no, these tariffs are here to stay. This is going to make things fair, right? This is going to make things right in the world with respect to trade between the US and many other countries. And we were left wondering, is this a negotiating tactic? Is this not a negotiating tactic? And people like Peter Navarro, his personal advisor to the president, was saying, no, this is not a negotiating tactic. These tariffs are here to stay. And well, the good news is, as we now know, that was not the case. That a few days later, the president did say, well, if a country were to come forward and offer me something, then maybe we could have a bit of a bargaining session or a trade talk, and we could come up with some negotiations. So that was the first shift in tone. I know that obviously since then there have been many other shifts in tone. We've seen carve-outs for certain segments of the market, whether it's computers or phones, or whether just recently automotive parts cut a carve out for that, because obviously the automobile companies, the GMs, the Fords, they were obviously trying to lobby the Trump administration and say, listen, we need more time. We need to be able to, if we're going to move business back, we just can't do it that quickly, and we need a little bit of help. And so the president has said that he was going to have some leniency with respect to automotive industry, automotive parts, and that will be possibly a 1 to 2 year exception, but eventually tariffs would be put back on. And then finally, this whole 90-day pause, a 90-day pause on the tariffs, again, a change in tone. But what caused that change in tone? Well, I actually mentioned it in the interview with Patty Levitt-Reed and John Chevreau, in that I think the market dictated the change in tone. I think when the bond market started to sell off, when bonds started to sell off, U.S. government bonds started to fall in price. The yield started to spike north of 4.5% on a 10-year bond. That really spooked Treasury Secretary Bessent, and I think he communicated that to President Trump. Perhaps countries are selling U.S. Treasuries. They're no longer holding U.S. Treasuries, which is not a good thing. I also think there was a change in tone when the president called all the major CEOs of retailers in the United States to the White House, the Home Depots, the Targets, the Walmarts. And I think the message was very clear that price of goods is going to go up, and it's going to go up fairly soon. There is a lot of inventory that has come into the United States over the first couple of months, but that's only going to last for so long. And I believe, this is my own belief, that probably have about 6 months worth. So sometime around the end of May, beginning of June, you're probably going to see prices really start to move higher. And if they don't move higher, well, the other fear that, or the other thing that the CEO said to the president was that either prices go higher and we on the goods that we sell, or there's just going to be empty shelves or emptier shelves. You go to a store and you want to buy a blue pair of Nike sneakers. Well, they may not have size 9, they may have size 7. Well, if you're size 9, you're out of luck. And well, if you find a size 9, but they may only have red or black, red and white, or black and white versus blue and white that you want. So definitely there are going to be some inventory issues. And again, that is probably going to start sometime in the next, well, let's say next month or so. And so these are the things, in my opinion, that spooked the president, got him to change his tone and really start to speak about bargaining and coming to the bargaining table and wanting to make a trade deal. And as I understand it, a lot of trade negotiations going on right now. There are a few countries that are very close, even a few that have already committed to a deal, which is positive for the stock market. Obviously, the big one is the trade negotiations between U.S. and China. We're hearing that they're speaking, but maybe on a low level, nothing to do with the two heads of the country, so President Trump or President Xi. We haven't heard that they're speaking as yet, but just the idea that they're speaking, in my opinion, has taken this trade war to the next phase. The next phase of the trade war is negotiation, and then I believe the next phase after that will be when we hear actual trade deals being done. So stay tuned for that. But for now, just this idea that the United States is open to making a trade deal, that has made, or at least caused, the markets to go significantly higher in the last few weeks. And we saw last week, the market went, it was the best market for best weekly returns. It's actually the second best week in the markets that we've seen in 2025. And the market didn't even go that high in the US. It went a few percent higher, but that alone was enough just to be the second best week for the market. So you can see that anything positive is going to move these markets to the upside. So let's move over to a few charts that we have here. And these charts will clearly show you how the Trump administration has done in the first 100 days or so. First chart here, percent change in S&P 500. And it'll show you here, and some of you may not be able to see the names of the presidents there. President Biden is the top line, President Obama the second, Trump 1.0, so his first term. That shows you how well he did. And then Bill Clinton shows you there, first 100 days, how he did. And then if you go down, President Bush, I believe this is President Bush Jr., the second President Bush. And you can see there, Trump 2.0. How poorly has the S&P 500 done in the first 100 days under Trump 2.0? I know the president has hinted that he's not as concerned about the markets as perhaps we all thought. I don't think that's true. I think he is concerned about the markets. I think their whole administration measures their success based on how well the markets do. So seeing Trump 2.0 fall that low has to be affecting the decisions that the president is now making. Our next chart shows the US dollar. Look how low the US dollar has gone. Trump 2.0 again, the lowest that we've seen when you compare after 100 days on all the other presidents. And, when you look at the dollar and you look at even when you look at approval ratings for the current president, it's one of the lowest approval ratings after the first 100 days that we've seen from any president in the last many presidents. So right around, all right across the board, President Trump is not really, making any friends, or however you want to say it. He's not really doing a whole lot to improve the way people think about him. Whether he cares or not, I don't know. But I know a lot of people have a lot more negative view of President Trump now after the first 100 days than they did. Remember, he came into power. He was supposed to be a business-friendly president. And obviously, according to the markets, the dollar and other things, he's been nothing of the sort. Our next chart here goes into trade between the two largest economies in the world. There it is, China and the US. And we've heard that there are ports running at 60% capacity. We've heard that imports into the United States on the West Coast from Asia are down about a third, 35% or so. So the ports are emptier. There's not as much business going on at these ports. And this is actually the container ship count. So this is departures from China to the United States. And you can see a very sharp decline that we've seen in containers coming over from China. So I have to believe that all these factors are definitely playing a part in the decision-making of the Trump administration and the president himself. And that's why I believe he has carved out a bunch of exceptions for certain sectors of the economy. And I believe that also why he gave a 90-day pause. And the question is, how many trade deals can they make in these 90 days? Perhaps he'll extend the 90 days. I'm not sure, but I guess time will tell. But for now, definitely we're seeing a change in tone, but for the better. And that's a good thing, especially for the stock market. Top three things to consider before you make your investment decisions. A very popular part of our show. You can see here, these are our three things for this week. Be mindful of range-bound markets. A lot of people think that the market is range-bound right now, and we'll talk or explain what we mean by that. Key economic data. We received some key economic data just this morning. PCE came out in the US. That's the preferred measure for the Federal Reserve to look at with respect to inflation. How is inflation going? We also know that we have a jobs report coming out at the end of this week. The Fed will meet next week and give us their update with respect to interest rates. So key economic data, we'll touch on that briefly. Corporate earnings, we are knee deep, maybe waist deep, or up to your neck perhaps in corporate earnings. They're coming out fast and furious a lot. Pretty much most of the banks or all the banks in the US have reported. Now we're getting into the big tech earnings. We had Google already report, or Alphabet. We will have Meta today report, Amazon, Microsoft this week, Apple, NVIDIA will report towards the end of May, but AMD, I believe, reports coming up in the next few days as well. So corporate earnings is the third topic or third idea you need to watch. So let's move on to our first idea. Be mindful of range-bound markets. And what do we mean by range-bound? Well, let's show our first chart of the S&P 500. This is a chart, I believe it's a year-to-date chart. There you have it. And what we mean by range-bound, if you take where the markets were beginning of April, you can see it had a very sharp decline in April, going back even all the way to, let's say, middle of March. and where the market is today, you can see the market really hasn't gone anywhere. It's gone down and then right back up. A lot of individual investors believe that this market is range bound because of earnings, because of uncertainty. So what we mean by that is a lot of companies can't tell us what they're going to make or how much money they're going to make, their earnings, what their earnings look like in quarter two, three, or for the full year. They're removing their full year guidance. So how much further can markets go if there is no guidance? And so basically what researchers do, analysts do, investment advisors like myself do, we take, okay, well, let's say the S&P 500 could have maybe, $250 of earnings for the whole S&P 500. You put a 20 times multiple, which is a little pricey. Maybe you have 5,000 on the S&P 500. Or maybe if you think earnings multiples are a little high, 250 is a little high, maybe $200 multiple earnings per share of the S&P 500. Again, 20 times earnings. Now you have a 4,000 point mark on the S&P 500. So you start to figure out, you add up all the earnings that are coming out from all the companies on the S&P. You figure a multiple, 18 times earnings, 20 times, 22 times. We got up to 22 times at the beginning of this year. And you can start to see how much higher the markets can go. And to me, it's tough. It's tough to start to get significantly higher. I think you're going to have to start to see earnings on the S&P 500 get closer to $300. Then you put a 20 multiple, and now you're looking at 6,000 points on the S&P 500. We're at 5,500 roughly today. So most people think that the S&P 500 is range bound between 4,800 on the downside and maybe 5,500 on the upside, and that's where we sit today. And I'm not so sure I agree with that. I think we can move higher. Our next chart here shows the Nasdaq, and again you can see that it's gone down, but right back up. And again, that back up has everything to do, in my opinion, with the talk about trade negotiations, or at least the beginnings of trade negotiation talk between China and the U.S. Our next chart shows the S&P 500 PE ratio for the S&P 500. There it is. You can see a big spike back in all the way from 2019 to 2021, the COVID days, if you will, then right back down during 2022 when the interest rates went up 11 times in the US and in Canada, started to move higher, 23, 2024, two fantastic years. But again, S&P starting to get stretched. And now most recently, S&P numbers coming down again. Sorry, I should say PE numbers for the S&P coming down again. And that just means that, yes, there are bargains out there, which is a positive thing. So whenever you see these kinds of things happening, in my opinion, it's actually a positive. So first point I wanted to make was that being mindful and thinking about these ranges, the low end, the high end. We start getting close to the higher end of the range. Maybe that's when you start to be a little bit more cautious. Next point, I wanted to talk about key economic data. And as I said, we have a lot of economic data coming out in the next little while. We had US GDP reports just this morning. Our first negative, or I shouldn't say the United States' first negative GDP quarterly report that we've seen in quite some time. In Canada, we're just kind of flatlining. So that came out. We have a chart on that right now. There it is, our first quarter for the US GDP, the first read of it, 0.3% negative. You could see coming out of end of last year, Q4, 2.4% positive. So a big fall off in that. We also had PCE, which is the inflation data out of the US. That, here you have it. That actually has come down, and it makes sense that it would come down. If the economy is slowing down, then inflation should be coming down as well. 2.6% on the headline number. Sorry, 2.6 on the core number, which excludes volatile food and energy, and 2.3% on the headline number. So inflation is coming down, but that is possibly because we're seeing a slowdown in the US economy. Our next bar charts here show Canadian GDP. We had that number as well. You can see February was pretty much a flat line, pretty much not much growth at all. So we're getting close to negative ourselves. That number was just released. And they also hinted that March would not be much higher, and 0.1%, not nearly as well as what we saw earlier in the year. So corporate earnings, economic data. Corporate earnings is going to be our next one, but economic data, that is something to consider. Also, keep in mind a Fed meeting next week. He's going to take the Federal Reserve, Jerome Powell, along with the Fed governors, will take all the economic data into account. They're going to take into account possible slowdown, jobs, which will come out on Friday, PCE, as I said, GDP, all that, and give us a rate announcement come next Wednesday. So stay tuned for that. The third point I wanted to bring across to everybody that you should be keeping an eye on before you make your investment decisions are corporate earnings. And I have some charts of some stocks that we talk about often on our show and some that we don't talk so often on our show about. But Alphabet reported a fantastic quarter. We have a chart on Alphabet here. You can see on the far right-hand side, Alphabet stock really starting to come off its lows. It got as low as, I think about 140, 145, all the way up to about 160. Markets are down today, so I think Alphabet is slightly down this morning and now coming into our show. But it's a stock that trading at 17 times earnings, forward earnings. I think you could get excited about a name like Alphabet, so dominating in search, in advertising, in AI, the cloud. They're pretty much right across the board. And most recently, driverless vehicles. So name like Alphabet is a name I think is quite cheap. Our next chart, Meta Platforms, formerly Facebook. This stock was once a $740 stock, now at around $550. They will report earnings, I believe, this evening. A name that I think you could take a look at, obviously, if you have the appetite for risk that a name like Meta brings. Microsoft also will report earnings. And Microsoft as well, our next chart, you can see Microsoft, another name coming up, or the price moving higher recently with the talk that the U.S. has at least begun or hinted at talking to China with respect to lowering tariffs. I know the Chinese have lowered tariffs on some U.S. goods, and there's been some talk that the U.S. will do the same. Another chart here, Amazon. Amazon, another big cap tech name, biggest company, one of the biggest companies in the world today. Again, all these charts looking very, very similar. Thought I'd switch gears, show you a chart of a pharmaceutical. Someone was asking me about pharmaceuticals recently. So one of the biggest pharma companies in the world, Pfizer. Let's take a look at Pfizer. It kind of looks like a tech chart, doesn't it? With Pfizer actually coming out with earnings this week, very strong, increasing their earnings outlook going forward. But the biggest problem with Pfizer right now is it's still being looked at as a COVID stock, a stock that, even though they're very much into oncology, they're still being looked at as, COVID vaccines and whatnot. The good thing about Pfizer, pays well over a 6% dividend. I actually think now stock is actually paying over a 7% dividend. Hopefully they can maintain that dividend and it's not cut. Next, biotech name, pharma name, Regeneron. Regeneron has one of the biggest pipelines. I know a name that I've been talking about to investors about. And Regeneron, they have drugs in oncology. They have drugs in eye disease, inflammatory disease, many different areas of the market. One of the biggest pipelines of any pharma biotech name. Yet, for whatever reason, the stock has been struggling because their eye disease medication has come off patent, and now it's being challenged by other competitors. So the numbers don't look as good. But I believe going forward, you will have some more blockbuster drugs out of Regeneron in some new areas. And last, but definitely not least, Netflix. This was a blowout quarter. You can see the stock really took off after they reported earnings. A name that is definitely not cheap on a price to earnings basis. So taking a look at it at these levels might be difficult, but perhaps on a dip. Netflix is a name that seems to be, recession or tariff proof, if you will. A lot of people ask me, can you name a stock that you could buy even during these times of high tariffs? Well, maybe Netflix is a name that works at this time. But again, keep in mind, it's not cheap. So another idea that I think individual investors need to focus on, corporate earnings, along with being mindful of the market trading in a range and the economic data that we've seen already and that we will see in the coming days. Those are the three things that you need to focus on before you make your investment decisions. Unique buying opportunities. And this is something that I've been talking to some investors about. And as I said earlier in the show, I think you should always be an investor. I think you should always be an investor in this market. Whenever you have cash available, you never want to time the market. And we know, as Patty Levitt-Reed said earlier on in our interview, the best days in the market always seem to come after the worst days in the market. And if you look back, the best days in the last 10 years or so, a lot of them came during COVID. A lot of them came, if you go back even further, a lot of them came during the financial crisis in '08. So if you go back over the last 20 years, that's what you would find. So timing this market is difficult. You never want to do that. And so lately, I've been telling investors that if you have the money to invest, you probably want to take a look at the markets today. Not that I'm trying to time markets, but I firmly believe, as I said earlier, we've gone to a different stage of the trade war, a stage where everyone now seems to be in that negotiation phase. And I think it's only a matter of time before we get trade deals between the United States and the rest of the world, I guess, and that's including China. And I don't think as an investor, you want to wait for that to happen, because by the time that happens, this market, we've seen it, the Dow Jones going up 3,000 points in a day. I don't know if that will happen again, but I think you could see significant moves in a very short period of time, and it'll be very difficult to try and get in at that time. I think you want to buy if you have funds available. And right now, let's face it, there are a lot of things on sale, 20, 25, 30% off in the tech space, in the financial space, in the pharmaceutical space, retail names, industrials. There are bargains to be had everywhere. And I think, to me, right now, the tariffs and the trade negotiations is presenting some buying opportunities. And again, what we can show where the S&P 500 is right now, we have a chart. This is I believe, a 1-month chart. There it is. And you'll see that, yes, ever since we've come to the realization that the U.S. is willing to negotiate, that, that the stock market is taking this as a positive, and the markets are moving higher. And our next chart here shows Trump's trade war timeline. And, we didn't want to show everything there, but the main point is that I think things have now changed, as I said, gone to the next level. And because we have gone to the negotiation or gone into the negotiation phase, whether or not the trade deals are good, bad, or whatnot, just the idea that countries are coming to the table and willing to speak, that is the first step. And as I said, I think overall, once we start hearing some trade deals, to me, I think the market will then go to the next level. And as an investor, I think you could take a look at these times as a pretty good opportunity to perhaps get some money working for you. So the American consumer definitely has lost confidence, and we've seen that in a lot of the numbers. Looking at it here, just getting the data, American consumer confidence fell 7.9 points, almost 8 points, into 86 in April, the lowest reading in almost 5 years, according to the Conference Board. Consumers' view of the next 6 months dropped 12.5 points to 54.4, which is the lowest reading since October 2011. So consumers are have definitely lost their confidence. They believe that higher prices are coming. They believe that shelves will be emptier. Perhaps job loss is playing a factor there. We've seen a lot of jobs being lost in many areas of the economy. And, that has caused a lot of anxiety for many people. The low confidence numbers come out as the number of American job openings were down to 7.1 million. That was down from almost 7.5 million just the month prior. So, yeah, we're seeing job openings coming down. We're hearing about job loss. Consumer confidence numbers are down. Our first chart here we can show tracking U.S. consumer sentiment. There you have it. It shows it clear. as day, and it shows a couple of different parts of the chart. I'll read them quickly. June 2022, 50 points. That's where the confidence number was. In 2022, obviously, we had interest rates moving higher. Historical low on the confidence. That was the low point there. But we're getting close to that again. Consumer confidence coming in at 52.2, which is not much higher than the low point on our chart. Keep in mind the dotted line is 80, which is the 20-year average. Our next chart, U.S. consumer inflation expectations remain elevated. There you have them. You can see that after surging and then softening, it looks like you're seeing a surge, or at least a little bit ticking higher again in inflation, and that's April 2nd tariff escalation on the left and the partial pause on April 9th. That was good for inflation, but now it's starting to move higher once again. Our next, I guess, chart here shows the job openings rate, seasonally adjusted, and you can see that that has been falling steadily as well. So overall, it's no surprise that consumer confidence is at a low point, almost as low as what we saw back in 2022 when interest rates were moving higher very quickly. That eventually will start to seep into or start falling into the data, the economic data, whether it's job creation data, whether it's retail sales creation, retail sales, whether it's GDP or growth. When you start losing confidence, when the consumer starts losing confidence, that's never a good thing for any economy, especially the United States, which the consumer makes up about 70% of the growth in the economy. Quick hits, part of the show where I talk about three things that you may have seen in the news. First one, China's Huawei develops a new AI chip seeking to match NVIDIA. Yes, now that NVIDIA is not able to sell chips into China without a license, companies like Huawei are taking that as an opportunity. Number two, Trump's tariffs are attacking the U.S. trade deficit. Does it need fixing? I don't think it does, and many people would agree with that. And our last point, Walmart, Target, CEOs privately warned Trump tariffs could lead to empty shelves soon. These are the three things that I've seen in the news recently that have caught my eye. So let's go to the first one, the Huawei situation. And as I said, recently, NVIDIA was told that you need a license to be able to sell your H20 chips into China. And as we know, we can show our chart that goes along with this topic. There it is. We know that NVIDIA keeps making new chips for China amid the U.S. crackdown. And every time it makes a chip, it's never as powerful as the chips it has for everybody else. It makes a weaker and weaker chip that it sells to China. And you can see here that they've introduced many chips. The last ones being the H20 chips, and then NVIDIA introduces in 2024 February L20, L2 chips. So constantly revamping, trying to meet what Washington has said they need to do before they can ship chips to China for artificial intelligence. And now looks like the United States has outright told NVIDIA you cannot ship anything without a license. In the meantime, other competitors have been moving into and gaining traction in the Chinese market. Definitely not good for NVIDIA, and we'll see how that plays out. Our second point, which are Trump tariffs have been designed to attack the trade deficits. Keep in mind, when the United States has a trade deficit with a country, it just means that they're buying more from that country than that country is buying from them. And when you look at the United States, such a big and powerful and wealthy nation, you compare that to a nation like Vietnam or a smaller country in Asia or even in Europe, yes, you're going to have a trade deficit because you buy or they're buying more from that country. Let's say Nike goes to Vietnam and sets up shop and brings over all their products, or China brings over their products. The United States is buying these goods. So yes, it shows that there is a trade deficit, but that's a good thing. That's a good reason. It's not that they're lending money to everybody and they're blowing money frivolously. They are buying goods. And when they're buying more than what they're selling, you have a trade deficit. So I don't believe it needs fixing. All this talk about trade deficits and the administration trying to reduce it to zero. I don't think it can be done, to be honest with you. I don't think you're ever going to get Vietnam buying from the United States as much as they're buying from Vietnam, but we'll see what happens. Our third point is the CEOs going to Washington and talking about empty shelves. Could we see empty shelves in the United States? Could Walmart show empty shelves in their stores? And I think that really scared at least the administration. If it didn't, I think it should, because it is very possible that we're either going to see goods in the United States a lot more expensive that you buy at Amazon or Walmart, Target, Costco, or you might see no goods at all. And we have a chart here that shows basically blank sailings increase as the trade war continues. And what this chart shows, and you can read it here, in the 12th week, 2025, blank sailing schedule for the beginning of May, we're near zero. You can see that on the far left of the chart. They were as high as 40% of all ships crossing the Pacific 4 weeks later. What does that mean? Well, blank sailings means that you have ships that are destined for the United States, but if they have nothing to drop off at the US, they will skip the US and deliver those goods somewhere else. So we're now seeing as many as 40% of ships not actually coming to the US any longer. They're skipping the United States and going elsewhere to sell their goods. So something I think the administration needs to be focused on, something that definitely caught my eye over the last couple of weeks, and something I wanted to bring to all your attention. So all these things hopefully will get the president to continue to try to negotiate with these countries and make some trade deals as soon as possible. What's my take? Favorite part of the show. And one question that I received recently stood out to me. I wanted to go through that just very quickly. I know we're kind of short on time here as we're getting close to the 1 o'clock hour. Client or investor, I guess, asked me, I exited the market when volatility started a few weeks ago. When do you recommend I buy back in? An awesome question. And it's something we talked about in our interview with Patty and John. As we said, both Patty and I, it's easy to know when to get out, but how difficult is it to know when to get back in? And that's the problem. And that's why I believe you should never get out of the market. And if you're trying to get back in, my advice to you would be get back in as soon as possible. Look for good quality investments at all times. And if you do that, getting out of the market is really never an option. You want to stay invested. You may move money around from one investment to another, but you really shouldn't get out of the market altogether, especially if your intentions are to get back in at a later date. So with that, I want to say thank you to everybody who watched our show today. I hope that our interview with Patty and John was very informative. I want to thank both of those individuals for coming on our show again. Hopefully we don't have to wait another year to have them on our show. Fantastic guests, very knowledgeable. And as always, I want to thank all of you for tuning in. And I want to thank you for watching, and tune in again 2 weeks' time for our next episode of the Allan Small Financial Show, 12 noon. I believe that is Wednesday, May the 14th. And until then, happy investing.